Before we begin, please note that the information in this video is for educational and informational purposes only and is not intended as financial or legal advice. I am not a financial advisor. The home buying and mortgage process is complex and varies by individual circumstances. You should consult with a qualified professional, such as a financial advisor, mortgage lender, and real estate attorney, before making any financial decisions. You're staring at a Zillow listing at 1 in the morning. It's perfect. The kitchen has that island you've always wanted, the backyard is big enough for a dog, and you can already picture where you'd put the Christmas tree. There's just one tiny problem. A giant, terrifying 30-year-long problem standing between you and that front door. The mortgage. Suddenly, your dream home turns into a nightmare of questions. What's the point? Is my credit score good enough? What's the difference between pre-qualified and pre-approved? Am I going to end up house poor? Eating ramen noodles for the next decade just to pay for a house I can't actually enjoy? If that sounds familiar, you are in the right place. Because the single biggest mistake homebuyers make isn't choosing the wrong house. It's not understanding the money behind it. And that confusion can cost you tens of thousands, even hundreds of thousands of dollars over the life of your loan. But it doesn't have to be that way. We've boiled down the chaos into the 10 most critical questions every single American homebuyer asks, or should ask, before they sign on that dotted line. Forget the complex jargon and the intimidating bank meetings. We are going to arm you with the knowledge to walk into this process with total confidence, save a massive amount of money, and turn that stressful nightmare back into the American dream. So let's dive straight into the number one question that kicks off this entire journey, the one that everything else is built upon. How much house can I really afford? Now, you might think the answer is simple. You go to a lender, they run your numbers, and they hand you a pre-approval letter that says, "Congratulations, you're approved for $500,000. You feel a rush of excitement. You think, great, time to shop for $500,000 homes. Stop. Right there. That letter is the single most misleading piece of paper in the entire home buying process. That number is not what you can afford. That number is the absolute maximum amount of debt the bank is willing to let you take on without them thinking you'll immediately default. It's the bank's number, not your number. The bank doesn't care if you can still afford to go on vacation, save for retirement, or handle a surprise medical bill. They care about one thing: the statistical probability that you will make your payment each month. Treating that pre-approval number as your budget is the fastest way to become house poor. You get the keys to your beautiful new home, and for the first month it's amazing. Then the second month comes and you realize after paying your mortgage, your utilities, your property taxes, and your insurance, you have almost nothing left. You can't go out with friends, you can't fix the leaky faucet without panicking, and that dream home starts to feel like a golden cage. So, how do you find your number? The real number? We start with a simple, time-tested guideline called the 28 of 36 rule. This is your new best friend. Here's how it works. The 28 means your total housing costs should not exceed 28% of your gross monthly income. That's your income before any taxes are taken out. And notice I said total housing costs, not just the mortgage payment. This is critical. We're talking about PITI, principal, interest, taxes, and insurance. Principal is the money that actually pays down your loan balance. Interest is the bank's profit for lending you the money. Taxes are the property taxes you pay to your local government. And insurance is your homeowner's insurance. People often forget about taxes and insurance, but they can add hundreds, sometimes over $1,000 to your monthly payment. The 36 part of the rule means your total debt payments should not exceed 36% of your gross monthly income. This includes your new housing payment, PITI, plus all your other recurring debts, your car payment, student loans, credit card payments, any other loans you have. Let's make this real with an example. Let's say you and your partner have a combined household income of $100,000 a year. Let's break that down. First, your gross monthly income is $100,000 divided by 12, which is about $8,333 per month. Now let's apply the 28% rule. We take $8,333 and multiply it by 0.28. That gives us $2,333. According to this guideline, your total monthly housing payment, your PITI, should be at or below $2,333 to live comfortably. But we're not done. We have to check the 36% rule. Let's say you also have a $400 car payment and a $300 student loan payment. That's $700 in existing debt. The 36% rule says your total debt shouldn't exceed 36% of your $8,333 monthly income. So, 8,333 times 0.36 equals $3,000. This is your total debt ceiling. You subtract your existing $700 in debts from that $3,000 ceiling, and you're left with $2,300. This is the maximum you have available for your housing payment. In this case, both the 28 and 36% rules give you a very similar number, right around $2,300 a month. This is your real budget. Now you can work backward with a mortgage calculator to see what home price that monthly payment actually translates to, after accounting for current interest rates, estimated taxes, and insurance in your area. You will almost certainly find that this number is significantly lower than what the bank pre-approved you for. And that is a good thing. That gap is your breathing room. It's your vacation fund. It's your emergency fund. It's your ability to live a life, not just pay for a house. Now, is the 2836 rule a perfect, unbreakable law? Of course not. It's a guideline, a starting point. If you have zero other debt, no car loans, no student loans, no credit card debt, you might feel comfortable pushing that housing percentage a little higher, maybe to 30 or 32%. If you have kids, plan on having kids, or have expensive hobbies, you might want to be even more conservative and aim for 25%. The ultimate tool here isn't a rule of thumb. It's your personal budget. Before you even think about talking to a lender, you need to become an expert on your own finances. Track every dollar you spend for at least 1 or 2 months. Use an app, use a spreadsheet, use a notebook. I don't care how you do it, just do it. Know exactly where your money is going. How much do you spend on groceries, on gas, on entertainment? Once you know your real-world spending, you can see how a new massive mortgage payment will fit in. It stops being an abstract number and becomes a real-world decision. You can say, okay, a $2,500 mortgage payment means we'd have to cut our eating out budget by $400 and our vacation savings by $300. Are we okay with that trade-off? This puts you in the driver's seat. You're no longer a passive passenger letting the bank tell you where you can go. You are the one setting the destination. You walk into the lender's office and you don't ask them, "How much can you give me?" You tell them, "Based on my budget, I am comfortable with a monthly payment of around X. Let's see what loan amount that gets me." It is a total shift in power. So the answer to how much house can I really afford isn't a number a bank gives you. It's a number you give yourself based on your income, your debts, and most importantly, your life. Get this first question right, and every other step of the process becomes clearer and less stressful. Get it wrong, and you're setting yourself up for years of financial strain. Now that you have a realistic budget in mind, you're ready to face the next giant hurdle that stops so many people in their tracks: the down payment. This leads directly to our second huge question: how much do I actually need to put down, and where on earth am I supposed to get that much money? The answer is not what you think, and the myth of needing 20% is costing people their dream homes. We're going to shatter that myth next. For decades, the number 20% has been hammered into our heads. It's the gatekeeper to the American dream, a financial dragon you have to slay before you can even think about owning a home. Well, I'm here to tell you that dragon is mostly smoke and mirrors. The 20% down payment isn't a law. It's not a rule. It's a preference, and it's one of the most damaging financial myths holding people back today. So where did it come from? It all boils down to one thing: risk. From a lender's perspective, a borrower who puts down a large chunk of their own money is less likely to walk away from the loan if times get tough. They have more skin in the game. Putting down 20% is the magic number that tells lenders you're a safe bet. In return for you taking on that initial risk, they reward you by not requiring you to pay something called private mortgage insurance, or PMI. We'll get to that monster in a minute. But here's the reality in today's market. Saving up 20% of a $3, $4, or $500,000 home is like trying to fill a bucket with a hole in it. By the time you get close, home prices have risen and the bucket is suddenly bigger. You're constantly chasing a moving target. It's a frustrating, soul-crushing cycle. And the lenders know it. The entire system knows it. Which is why a whole universe of options exists that most people don't even know about. Options that let you buy a home with dramatically less. Let's start with the people's champion, the FHA loan. Backed by the Federal Housing Administration, this is the workhorse of the first-time homebuyer market. The FHA loan allows you to buy a home with as little as 3.5% down. Let me say that again. 3.5%. On a $400,000 house, that's $14,000, not $80,000. That is a life-changing difference. It's the difference between buying a home this year, or maybe a decade from now. FHA loans are designed for people with solid incomes, but not a mountain of cash in the bank. They're also more forgiving on credit scores, making the dream accessible to more people. But what if you could do even better? What if you could put down zero? For millions of Americans, that's not a dream. It's a reality. If you are a veteran currently serving in the military, or a surviving spouse, the VA loan is, without a doubt, the single best mortgage product in existence. As a thank you for your service, the Department of Veterans Affairs guarantees a portion of these loans, allowing lenders to offer them with zero down payment. No down payment at all. And to make it even better, VA loans don't have that pesky PMI we talked about earlier. It is an incredible benefit earned through service, and if you're eligible, you need to know about it. Now you might be thinking, okay, that's great for veterans, but what about the rest of us? Well, there's another zero down option that is a true hidden gem: the USDA loan. When people hear USDA, they think of farms and cows. But the U.S. Department of Agriculture's definition of rural is incredibly broad. It includes huge swaths of suburban America, small towns, and communities just outside major city centers. In fact, 97% of the landmass in the United States is in a USDA-eligible area. You can literally go on their website, type in an address, and see if it qualifies. If it does, and you meet certain income requirements, you could be looking at a zero down payment mortgage. It's one of the most underutilized programs in the country. And finally, what about the good old-fashioned conventional loan? The one everyone thinks requires 20%? Even that's a myth. Many lenders now offer conventional loans with just 5% down. Some even have programs like the Conventional 97, which, you guessed it, lets you put down only 3%. 3% for a conventional loan. The gatekeepers have thrown the gates wide open. So you have options. FHA at 3.5%. VA and USDA at 0%. Conventional at 3 to 5%. The 20% myth is officially busted. But this all sounds too good to be true, right? There has to be a catch. And there is. It's that acronym I mentioned earlier. PMI, Private Mortgage Insurance. If you put down less than 20% on most loans, the lender sees you as a higher risk. So, to protect themselves, not you but themselves, they require you to buy an insurance policy. That policy, PMI, pays the bank in the unfortunate event that you default on your loan. You are paying the premium for an insurance policy that only benefits your lender. It feels a little unfair, and it adds an extra $50 to maybe a couple $100 to your monthly mortgage payment, depending on your loan amount and credit score. This is the trade-off. This is the cost of not bringing $80,000 to the closing table. And for years, financial gurus have screamed from the rooftops, PMI is a waste of money. Avoid it at all costs. And they are fundamentally wrong. They are giving you advice for a world that no longer exists. They fail to account for the single most powerful force in real estate: appreciation. Let's do some simple math. Let's say you want to buy that $400,000 house. Scenario A. You decide to avoid PMI. You spend the next 5 years saving up the full 20%, $80,000. But over those 5 years, in a normal market, that house isn't sitting still. Let's say it appreciates just 5% a year. In 5 years, that $400,000 house is now worth over $510,000. You've been saving your tail off just to watch the finish line run away from you. You've been priced out while trying to do the responsible thing. Now, scenario B. You buy that same house today with 5% down, $20,000. You have to pay, let's say, $150 a month in PMI. Over 5 years, you'll pay about $9,000 in PMI. But what else happened? You captured that $110,000 in appreciation. You paid $9,000 to gain $110,000 in equity. That isn't a waste of money. That is the best financial trade you will ever make in your life. PMI isn't a penalty. It's a tool. It's the price of admission to get into the market now and start building your own wealth, not your landlord's. And the best part? Once you reach about 20% equity in your home, either by paying down the loan or through appreciation, you can call your lender and get the PMI removed. It's not a life sentence. Okay, so we've established that the down payment doesn't have to be a mountain. It can be a much more manageable hill. But that still leaves the second half of the question. Where do you even get that money? Even $20,000 can be a stretch. First, look into down payment assistance programs, or DPAs. These are thousands of programs at the state, county, and city level designed to help people buy homes. They can be grants that you don't have to repay. They can be silent second mortgages that you only repay when you sell the house with zero interest. People leave literally billions of dollars on the table every year because they don't know these programs exist. A good local lender or real estate agent should be your guide to finding them. Second, there's the power of gift funds. The bank wants to see that you have the money, but for most loans, they don't care if it's your money. A parent, a grandparent, a sibling can give you the money for your down payment as a gift. They just have to sign a simple letter stating it's a gift, not a loan that needs to be repaid. This is an incredibly common way for families to help the next generation get a foothold in the market. So the path is clearer now. You don't need 20%. You can use powerful loan programs like FHA, VA, or USDA. You can view PMI not as a penalty but as a strategic tool. And you can get help with the down payment you do need through assistance programs and family gifts. The biggest barrier to entry isn't as big as you thought. But now that the money part seems more manageable, a new fear starts to creep in. It's that other big, scary number that rules our financial lives: your credit score. What if it's not perfect? What if you had some trouble in the past? How high does that 3-digit number really need to be to get a mortgage? Is the dream over before it even begins? The minimum score you actually need might be the biggest shock of all, and we're breaking that down next. Alright, let's cut right through the noise. For years, you've probably heard that you need a nearly perfect credit score, something north of 750, maybe even 800, to even think about buying a house. It's the kind of gatekeeping that makes millions of Americans feel like homeownership is a private club they'll never get into. But what if I told you that the actual hard-coded minimum score to get a government-backed mortgage is 500? Yes, 500. That's not a typo. Now, before you run off to apply, there's a massive asterisk next to that number, and understanding it is the key that unlocks everything. Let's break down the real-world minimums loan by loan because this is where the game is truly played. First up, the FHA loan. This is the one backed by the Federal Housing Administration, designed specifically to help people with less than perfect credit and smaller down payments. Officially, the FHA has 2 tiers. If your FICO score is 580 or higher, you can qualify for their flagship program, which requires only a 3.5% down payment. This is the number you should burn into your memory: 580. It is the single most important credit score threshold for a huge number of first-time homebuyers in America. Now, what about that 500 score I mentioned? The FHA says if your score is between 500 and 579, you can still get a loan. But here's the catch. You have to put down 10% instead of 3.5%. For many people in that credit range, coming up with a 10% down payment is a much bigger hurdle than the credit score itself. So while it's technically possible, the 580 score is the practical golden ticket for most FHA borrowers. Next, we have the VA loan for our veterans, active duty service members, and eligible surviving spouses. Here's a mind blower. The Department of Veterans Affairs itself sets no minimum credit score. 0. They don't have one. They leave it up to the individual lenders to decide. This is a critical concept we'll come back to called lender overlays. In the real world, you will be hard-pressed to find a lender who will approve a VA loan for someone with a 520 credit score. Most lenders will impose their own minimum, which typically lands somewhere around 620. So for VA loans, forget the official rule and focus on the practical one. Aim for 620 or higher. It's a similar story with USDA loans, those incredible zero down payment loans for homes in eligible rural and suburban areas. The USDA doesn't have a hard minimum score, but their automated underwriting system strongly favors scores of 640 and above. Below that, your application requires a much tougher manual review. So again, while there's no official floor, the practical target you should aim for is 640. Finally, we have conventional loans. These are the loans that aren't backed by the government, the ones people often think of as the standard mortgage. Think Fannie Mae and Freddie Mac. For these, the minimum score is much more firm. It's 620. Period. Getting a conventional loan with a score of 619 is next to impossible. So let's recap the practical, real-world minimums. FHA is 580. VA and conventional are both around 620. And USDA is 640. Notice a pattern? None of these are 750 or 800. The door to homeownership is open much wider than most people think. But here's the multi-$1,000 question. Just because you can get a mortgage with a 620 score, should you? This is where we separate myth from the math that will define your financial life for the next 30 years. Your credit score is quite simply a risk rating. To a lender, a low score means there's a higher statistical chance you might miss a payment or default on the loan. It doesn't mean you're a bad person. It's just a cold, hard calculation based on your past financial behavior. To compensate for that higher risk, they do two things. They charge you a higher interest rate, and they charge you for something called private mortgage insurance, or PMI. Let's imagine two homebuyers, both trying to buy a $400,000 house with 5% down. Our first buyer, let's call her Jessica, has worked hard on her credit and has a 760 score. Our second buyer, Mike, has had a few bumps in the road, a late car payment, high credit card balances, and has a 630 score. Both of them can get approved for a conventional loan. They both get a house, but their financial futures will look drastically different. Jessica, with her 760 score, might get an interest rate of 6.5%. Mike, with his 630 score, is seen as a bigger risk, so the lender gives him a rate of 7.5%. 1 percentage point. It sounds so small, doesn't it? But let's run the numbers. Jessica's monthly principal and interest payment is about $2,400. Mike's payment is about $2,650. That's a $250 difference every single month. That's $3,000 a year. That's a family vacation. That's a huge contribution to a retirement account. That's your car payment. Over the 30-year life of the loan, Mike will pay over $90,000 more in interest than Jessica will for the exact same house. Let me say that again. $90,000 more. All because of that 1 percentage point difference tied directly to his credit score. And we haven't even talked about PMI yet. Because Mike is putting down less than 20% and has a lower credit score, his PMI will be significantly more expensive than Jessica's. He could be paying an extra $100 to $150 a month just for that, on top of the higher interest payment. Suddenly, that 630 score is costing him $400 a month every month for years. This is the hidden tax on having a lower credit score. It's not about getting approved, it's about the total cost of borrowing. The difference between a fair score and an excellent score isn't just bragging rights. It's the price of a luxury car, or a full college education for a child, paid out over 30 years. So what do you do if you're like Mike? You're in the low to mid 600s and you want to buy, but you don't want to be penalized for the next 3 decades. The good news is that your credit score is not a permanent tattoo. It's a living number that you have incredible power to change, sometimes faster than you think. Your score is basically made up of 5 ingredients. Payment history is the biggest at 35%. Are you paying your bills on time? Amounts owed? Or your credit utilization is 30%. Are your credit cards maxed out? Length of credit history is 15%. New credit is 10%. And credit mix is the final 10%. The fastest way to boost your score is to attack the biggest piece of the pie you have control over right now, that 30% for amounts owed. If you have credit cards with high balances, paying them down is the single most effective lever you can pull. The magic number is 30% utilization. If you have a card with a $10,000 limit, you never want the balance to be more than $3,000. But if you really want to supercharge your score, get it below 10%. Paying a card from a $5,000 balance down to $900 can sometimes boost your score by 30, 40, even 50 points in a single month. Another powerful tip: check your credit report for errors. 1 in 5 Americans has a mistake on their report. A bill that isn't yours, a late payment that was actually on time. Disputing and removing these errors can be a game changer. And don't just pull one report. Get all 3 from Experian, Equifax, and TransUnion, because they don't always share information. The bottom line is this: while the minimum score to get a mortgage is surprisingly low, the score you should aim for is the highest one you can possibly achieve. Getting from a 630 to a 680 might only take a few months of disciplined action, but it could save you $50,000. Getting from a 680 to a 740 could save you even more. The score isn't just a number a lender uses to judge you. It's a tool you can use to control your financial destiny. It determines not just if you can buy a home, but how much that home will truly cost you. Now that we've cracked the code on credit scores, there's another giant myth looming over every homebuyer. It's a number that's been drilled into our heads for generations. A number that makes millions think they have no shot at buying a home. 20%. The down payment. Do you really need to show up with a suitcase full of cash? Do you have to save for 10 years just to get your foot in the door? What if I told you the 20% down payment is the biggest myth in real estate? The truth about how little you can actually put down, including options for a true zero-down mortgage, is coming up next. The number one reason people believe they can't buy a home is a lie. A myth so pervasive, so deeply embedded in our culture, that it stops millions of potential homeowners dead in their tracks before they even start. You've been told, probably by your parents, your friends, maybe even a well-meaning but outdated financial guru, that you absolutely must have 20% of the home's price saved for a down payment. For a $400,000 home, that's $80,000 in cash. For most people, that number feels like trying to climb Mount Everest in flip-flops. It's an impossible, soul-crushing goal that forces you to rent for years, throwing money away while home prices climb higher and higher, pushing that 20% target even further out of reach. So let's shatter this myth into 1,000 pieces. Where did this magical 20% number even come from? It's not a law. It's not a rule. It's simply the threshold to avoid something called private mortgage insurance, or PMI. That's it. That's the whole secret. When you put down less than 20%, the lender sees you as a slightly higher risk. You have less skin in the game, so to speak. To protect themselves, not you but themselves, in case you default on the loan, they require you to pay for an insurance policy. That's PMI. It's an extra fee, typically rolled into your monthly mortgage payment, that acts as a security blanket for the bank. And because it benefits the bank, everyone has been conditioned to think of PMI as a penalty, a tax on the poor, a financial monster to be avoided at all costs. But what if I told you that, for many people, PMI isn't a monster? What if it's actually the golden key that unlocks the door to homeownership and wealth creation years ahead of schedule? Let's play this out with the story of two potential homebuyers, Sarah and Tom. Both are looking at similar starter homes in their area, priced at $400,000. Tom is a diligent saver. He believes the 20% myth. He needs $80,000. He's saving $1,000 a month, which is already a huge accomplishment. But at that rate, it will take him 80 months or almost 7 years to hit his goal. Now let's look at Sarah. Sarah learns that the 20% rule is a myth. She finds a loan program that only requires 3% down. For the same $400,000 house, her down payment is just $12,000. She already has that saved. So she buys the house. Yes, she has to pay PMI. Let's say it costs her about $150 a month. Over those same 7 years that Tom is saving, Sarah will pay $12,600 in PMI. That sounds like a lot of wasted money, right? That's what the myth wants you to think. But what happens in the real world during those 7 years? Let's be conservative and say the housing market appreciates at a modest 5% per year. Tom is still on the sidelines renting. His rent is probably going up every year. He's building zero wealth. He's just watching. Sarah, on the other hand, is in the game. After 7 years, that $400,000 house she bought is now worth over $560,000. She has gained $160,000 in equity from appreciation alone, plus the portion of her mortgage she's paid down. She spent about $13,000 on PMI to gain over $160,000 in wealth. That's not a penalty. That's one of the greatest investments she will ever make. Meanwhile, what about Tom? After 7 long years, he finally has his $80,000. But the house he wanted is no longer $400,000. It's $560,000, and 20% of that is now $112,000. He's still $32,000 short. He's on a financial treadmill, and the speed just keeps increasing. Sarah is living in her own home. Her net worth has exploded, and she is miles ahead financially. Tom is still stuck, a victim of a myth. The math is undeniable. Paying a small PMI fee to get into a house now and start building equity is almost always a smarter financial move than waiting years to save 20%, while home prices and rents skyrocket around you. You are literally paying to get into the game early. So how do you do it? What are these magical low down payment loans? The most common is the FHA loan. Backed by the Federal Housing Administration, it allows for a down payment as low as 3.5%. FHA loans are fantastic because they have more flexible credit requirements, making them accessible to a wider range of people. But there's an even better option for many first-time buyers: the conventional 97 loan, offered through Fannie Mae and Freddie Mac. This program lets you buy a home with just 3% down. That's $12,000 on that $400,000 house. But here's the best part. Unlike many FHA loans where the mortgage insurance can stick around for the life of the loan, the PMI on a conventional loan is temporary. Once you've paid down your mortgage to the point where you have 20% equity in your home, through a combination of your payments and the home's appreciation, you can request to have the PMI removed. It even automatically falls off once you reach about 22% equity. You pay it for a few years, build wealth, and then it's gone. But we can do even better than 3%. What about 0%? What about a true zero-down mortgage? This is where the game really changes. If you are a veteran and active duty service member, or an eligible surviving spouse, the VA loan is, without a doubt, one of the best benefits you have earned. It allows you to buy a home with zero money down, no down payment required. And it gets better. There is no monthly PMI. This is an absolute game changer, a powerful tool for military members and their families to build generational wealth. But what if you haven't served in the military? There's another zero-down option that is the best-kept secret in real estate: the USDA loan. Backed by the United States Department of Agriculture, this program is designed to help develop rural and suburban areas. And you might be shocked at what the USDA considers rural. Many growing suburban towns just outside major city limits qualify. You can go on the USDA website and type in an address to see if it's in an eligible area. If it is, and you meet certain income requirements, you can buy a home with absolutely zero money down. Think about that. FHA at 3.5%, conventional at 3%, and VA or USDA at 0%. The 20% myth is not just wrong, it's destructive. And for those who still find that 3% down payment a challenge, there's one more layer to this. It's called down payment assistance, or DPA. These are programs run by state and local governments designed to help you cover your down payment and closing costs. They come in the form of outright grants, which is basically free money you don't have to pay back, or silent second mortgages, which are loans with no payments that are often forgiven after you've lived in the home for a certain number of years. Thousands of these programs exist all across the country, with money just sitting there, waiting for homebuyers who know to ask for it. You could combine a 3% down conventional loan with a 3% DPA grant and literally get into a house with almost no money out of your own pocket. The system is not designed to keep you out. It's designed with all these trapdoors and secret passages that let you in if you just know where to look. The 20% down payment isn't a wall. It's a curtain, and we just pulled it back. So now you know the truth about the down payment. You know that the biggest financial barrier you imagined is actually a myth. But that brings up the next big hurdle, the one that causes just as much anxiety: your credit score. Do you need a perfect 800 score to get a great mortgage? What if your credit is just average, or even a little bruised? How low can your score actually be to get approved? We are about to pull back the curtain on the exact credit scores lenders are looking for, and reveal the one simple trick that can boost your score faster than you ever thought possible. That's all coming up next. So let's rip the Band-Aid off. The biggest myth about credit scores is that there's one magic number you have to hit. The truth is, the score you need is completely tied to the type of loan you're trying to get. Think of it like this: getting into a state college has different requirements than getting into Harvard. Mortgages are the same way. Let's start with the most common one, the conventional loan. This is the loan most people think of, the one backed by Fannie Mae and Freddie Mac. For these, the unofficial industry standard, the number you'll hear almost everywhere, is a 620 FICO score. If you're below 620, the door is pretty much closed for a conventional loan. But here's the critical part most people miss. A 620 just gets you in the door. It doesn't get you a good seat. To get the best interest rates, the VIP treatment from lenders, you need to be aiming for a 740 or higher. The difference between a 620 and a 740 isn't just about getting approved. It's about saving tens, or even hundreds of thousands of dollars over the life of your loan. We'll break down those shocking numbers in just a minute. Next up, the FHA loan. This is the one backed by the government, designed to help people with lower credit scores and smaller down payments. The government's official, on-the-books minimum score is a 500. But I have to be honest with you, finding a lender who will actually approve a 500 score is like finding a unicorn. Why? Because even though the government insures the loan, the private lender is still the one putting up the money. They have their own rules called lender overlays. It's their way of adding an extra layer of security. So while the FHA says 580 is the minimum to qualify for their popular 3.5% down payment program, most lenders will draw the line at 600, or more commonly, 620. They just aren't willing to take on that level of risk. So the government guideline is one thing, the real-world requirement is often higher. Then we have VA loans, an incredible benefit for our service members, veterans, and eligible surviving spouses. Here's a mind-blowing fact. The Department of Veterans Affairs does not set a minimum credit score. Technically, you could get a VA loan with a 550 score. But again, that real-world factor kicks in. The private banks originating the loan will almost always have their own minimum, and you'll find that 620 is, once again, the most common benchmark they use to feel comfortable moving forward. Finally, there are USDA loans for buyers in eligible rural and suburban areas. Much like the VA loan, the USDA doesn't have a hard and fast minimum score, but their automated underwriting system, which gives you the fastest path to approval, strongly prefers a score of 640 or higher. So the big takeaway is that while lower scores can technically get you in the door for some government-backed loans, the real-world sweet spot to even begin the conversation with most lenders starts around 620. But your goal, your absolute mission, should be to get as high above that as possible, because your credit score is the single most powerful lever you have to control how much your house will actually cost you. So what is this 3-digit number that holds so much power? A credit score isn't just a grade. It's a story. It's your financial biography, telling a lender how you've handled debt in the past, which they use to predict how you'll handle it in the future. It's primarily made up of 5 ingredients. The most important, making up 35% of your score, is your payment history. It's simple. Do you pay your bills on time? Every late payment is a scar on your report. A 30-day late payment can drop your score by 60 to 110 points, and it stays on your report for 7 years. This is the foundation of everything. The second most important ingredient at 30% is your credit utilization. This is a fancy term for how much of your available credit you're using. Imagine your credit limit is a bucket. If you have a $10,000 credit limit and a $9,000 balance, your bucket is 90% full. You look overextended, financially stressed. But if you have that same $10,000 limit and only a $1,000 balance, your bucket is just 10% full. You look like you have everything under control. The golden rule is to keep your utilization below 30% on every single card, but the Real pros keep it under 10%. Next, at 15%, is the length of your credit history. Lenders love to see a long, stable history. It shows you're experienced in handling credit. This is why the worst thing you can do is close your oldest credit card account. Even if you don't use it, keep it open. Closing it erases that history and can make your score take a nosedive. The last 2 pieces are smaller, each at 10%. You have new credit, which looks at how many new accounts you've opened or applied for recently. Applying for a bunch of credit in a short time is a red flag. It looks like you're desperate for cash. And finally, you have credit mix. Lenders like to see that you can responsibly handle different types of debt, like a credit card, a car loan, and a student loan. It shows you're financially versatile. Okay, so you understand the ingredients. But what about that one simple trick I promised to boost your score fast? It's not about paying a sketchy credit repair company. It's something you can do yourself right now, and it's all about weaponizing that credit utilization piece. This is the factor you can change the fastest. You can't change your payment history from last year, and you can't magically make your credit history longer. But you can change your utilization in 30 days. Here's the trick. Most people think that as long as they pay their credit card bill in full by the due date, they're fine. But what they don't realize is that most credit card companies report your balance to the credit bureaus on your statement date, which is often weeks before your due date. So you could charge $4,000 on a $5,000 limit card during the month, pay it off in full on the due date, and a lender might still see a report that you had a sky-high 80% utilization. The trick is to pay your balance down to almost zero before the statement date. Find out when your statement closing date is for each card. A few days before that date, pay the balance down to just a tiny amount, say $5 or $10. Let that tiny balance be what gets reported to the credit bureaus. This strategy is sometimes called AZEO, or all zero except one. You pay every card to a zero balance before the statement date, except for one, which you leave a tiny balance on. Why? Because a report that shows you're using credit but using a tiny, almost insignificant fraction of it, makes your score skyrocket. It is the single fastest way to manipulate your credit utilization in your favor, and can add 30, 50, even 80 points to your score in a single month. I saw this happen with a client. Let's call her Sarah. She was stuck at a 615 score. She paid her bills on time, but she was using about 70% of her credit limits each month, even though she paid them off. She was frustrated. We had her implement this strategy. She used her debit card for 2 months and only let a tiny balance report on one credit card. Her score jumped from 615 to 680 in less than 60 days. That jump didn't just get her approved. It got her a significantly lower interest rate that saved her over $200 every single month. And that brings us to the most important point of all. Why should you fight tooth and nail for every single point? Because a higher score saves you a staggering amount of money. Let's look at a $400,000 mortgage. With a 640 credit score, you might get an interest rate of 7.5%. Your monthly principal and interest payment would be about $2,796. But with a 760 credit score, you might qualify for a rate of 6.5%. Your monthly payment would be $2,528. That's a difference of $268 every single month. That doesn't sound like a lot? Over the 30-year life of the loan, that adds up to over $96,000. $96,000 for the exact same house. That's a brand new luxury car, a college education, a dream retirement fund, all determined by that 3-digit number. Your credit score isn't just a number. It's a direct reflection of how much wealth you're going to build, or how much you're going to give away to the bank. Now, building a great credit score is a huge step, but even with a perfect 850, there's another giant number that stops most homebuyers dead in their tracks: the down payment. Everyone thinks you need 20% down, but that is the single biggest, most expensive myth in all of real estate. In the next section, we are going to completely dismantle that myth. We'll expose the truth about how much you really need to save, and reveal 3 legitimate, powerful ways you can buy a house with little, or in some cases, absolutely no money out of your own pocket. You don't want to miss this. Alright, let's talk about the biggest, most intimidating monster in the home buying process. The final boss that makes millions of people feel like homeownership is a fantasy reserved for the ultra-wealthy. I'm talking about the 20% down payment. It's the number that gets repeated like a sacred mantra by parents, financial gurus, and know-it-all uncles at every family barbecue. You can't buy a house until you have 20% down, they say. For a $400,000 home, that's $80,000. $80,000 in cash. For most people, that number isn't just a goal. It's a brick wall. It's the reason so many of us spend years, even decades, stuck in the rent cycle, feeling like we're on the outside looking in. The dream of painting a wall whatever color you want, of having a backyard for a dog, of building real, tangible wealth for your family. It all seems to get crushed under the weight of that one single number. Well, I'm here to tell you that the 20% down payment rule is one of the most pervasive and damaging myths in modern real estate. It is not a law. It is not a requirement. It is, for the vast majority of homebuyers in America, completely and utterly optional. So where did this myth even come from? It's actually rooted in a simple concept: private mortgage insurance, or PMI. Think of PMI like this. When you put down less than 20%, the lender sees you as a slightly higher risk. So, they require you to pay for an insurance policy that protects them, the lender, in case you default on the loan. The 20% down payment is simply the threshold where lenders feel comfortable enough that you have enough skin in the game, and they no longer require you to pay for that insurance policy. For decades, people have treated PMI like a plague, a penalty for not being rich enough. They've been taught to avoid it at all costs, even if it means waiting 10 years to save up that magical 20%. But here's the paradigm shift. The secret that savvy homebuyers understand: PMI is not a penalty. It's a tool. It's the key that can unlock the door to homeownership years, even a decade, sooner than you thought possible. Think about it. Would you rather pay a couple $100s a month in PMI for a few years while living in your own house, building your own equity as the home's value appreciates? Or would you rather pay 100% of your rent to a landlord for the next 10 years, building their equity, while you try to save an impossible amount of money in a savings account that's earning next to nothing? When you look at it that way, the choice becomes crystal clear. So let's kill this myth once and for all. I'm going to show you 3 powerful government-backed loan programs that let you buy a home with a ridiculously low down payment, and in 2 of these cases with absolutely $0 down. First up, what I call the veteran's secret weapon, the VA loan. If you are an active duty service member, a veteran, or an eligible surviving spouse, this is, without exaggeration, the best mortgage product on the planet. It was created as a thank you, a way to help those who have served our country achieve the American dream of homeownership. And its biggest superpower? A 0% down payment. That's right, 0. On a $400,000 house, you don't need to bring $80,000 to the table. You don't even need to bring $10,000. You need to bring zero. On top of that, VA loans do not have monthly mortgage insurance. It is a true game changer. If you have any connection to the military, the very first thing you should do is check your eligibility for a VA loan. It is a benefit you have earned, and it is the single fastest path to owning a home with no money down. Second, let's talk about the rural advantage, the USDA loan. Now, when you hear USDA, you probably think of farms, cows, and endless fields of corn. And you're not entirely wrong, but you're also not entirely right. The USDA Rural Development Loan Program was designed to encourage growth in less populated areas. And just like the VA loan, it offers a 0% down payment. Zero. But here's the secret most people miss. The USDA's definition of rural is incredibly broad. It doesn't just mean the middle of nowhere. It includes thousands of small towns and suburbs all across America. We're talking about communities with great schools, parks, and grocery stores that are just outside major metropolitan areas. There are eligible properties within a 30-minute drive of almost every major city in the country. You would be absolutely shocked to see the map. The USDA has an official eligibility map on their website. You can type in any address, and it will tell you instantly if it qualifies. For millions of Americans who think they're priced out of the market, their dream home is sitting in a USDA-eligible area, waiting for them to discover they can buy it with nothing down. Okay, so what if you're not a veteran and you don't want to live in a USDA-eligible area? What about everyone else? This brings us to the third and most popular option, what I call the people's loan, the FHA loan. The FHA, or Federal Housing Administration, loan is the workhorse of the American housing market. It was created specifically to make homeownership accessible to everyday people. And it doesn't require 20% down. It doesn't even require 10% or 5%. An FHA loan requires a minimum down payment of only 3.5%. Let's do the math on that. On that same $400,000 house, 20% is $80,000. But 3.5%? That's just $14,000. Now, $14,000 is still a lot of money, but it is a molehill compared to the mountain of $80,000. It's an achievable goal. It's a number you can save for with a plan, maybe in a year or two, not a decade. Yes, with an FHA loan you will have mortgage insurance, which they call a mortgage insurance premium, or MIP. But remember our mindset shift. It's not a penalty, it's the tool that gets you in the door. It's what allows you to start building wealth for yourself now, instead of for your landlord for the next 10 years. Now you might be thinking, okay, 3.5% is amazing, but even that is a stretch for me. This is where we get to the final, most powerful piece of this puzzle. The one that truly makes the promise of buying a home with no money out of your own pocket a reality. It's called down payment assistance, or DPA. These are programs typically run by state or local housing authorities that are designed to help you bridge the gap. They come in the form of grants, which is free money you don't have to pay back, or silent second mortgages, which are loans with very low or no interest that you often don't have to pay back until you sell or refinance the house years down the road. And here's the magic. You can combine a DPA program with an FHA loan. The DPA program can give you the 3.5% you need for the down payment. The FHA loan covers the other 96.5%. And the result is you walking into your first home, having paid little to nothing out of your own pocket for the down payment. These programs are real. They are available all over the country. You just have to know to ask for them. So let's recap. The 20% down payment is a myth. For veterans and those buying in eligible rural areas, the real number is zero. For almost everyone else, it's 3.5%. And with the help of down payment assistance, that 3.5% can also become zero. The barrier you thought was a 20-foot concrete wall is actually a 3-foot picket fence you can easily step over once you know where the gate is. You've just learned the single most important secret to fast-tracking your homeownership journey. You now know more than 90% of aspiring homebuyers who are still out there slowly filling a piggy bank, thinking they need to save for another 10 years. You're armed with the truth. But a down payment isn't the only cash you need to buy a home. Just when you think you've got it all figured out, you get a document from your lender called a loan estimate. And as you scan down the page, your heart sinks. You see a list of fees, thousands, sometimes tens of thousands of dollars in something called closing costs. Origination fees, underwriting fees, title insurance, escrow fees. It's a dizzying list of jargon that feels designed to confuse you and drain your bank account. What exactly are these costs? Are they all legitimate? And more importantly, are they negotiable? The answer to that last question is a resounding yes, but only if you know what you're doing. In fact, there is a powerful little-known strategy that can get the person you're buying the house from, the seller, to pay for a huge chunk or even all of your closing costs for you. And in the next part, I'm going to show you exactly how it's done. Alright, the secret is a strategy called a seller concession, but not in the way most people think about it. Now, the basic idea is simple. You ask the seller to contribute money towards your closing costs. In a buyer's market where sellers are desperate to attract an offer, you might just be able to ask them to chip in a few $1,000s and they'll say yes. But in a normal or a hot seller's market, if you offer the seller less money for their house and ask them to pay your fees, they'll probably just laugh and throw your offer in the trash. So, how do you get them to say yes? How do you craft an offer so irresistible they're not only happy to pay your closing costs, but they feel like they're winning too? You do it by reframing the entire negotiation. Instead of asking for a discount, you're going to structure the deal so the seller gets the exact price they want, and you get to finance your closing costs instead of paying for them in cash. Let's walk through this step by step with a real-world example. Imagine a house is listed for sale at $500,000. You love it, you can afford the monthly payment, and you have your down payment saved up. But then your lender tells you that you'll also need an estimated $15,000 in cash for closing costs. That's a huge extra expense that could drain your savings, or even make the deal impossible. Here's where the magic happens. A typical, uninformed buyer might offer $490,000 and hope for the best. A slightly more savvy buyer might offer the full $500,000 and ask the seller to pay, say, $5,000 of their closing costs. The seller nets $495,000. It's an okay offer, but you're going to make a world-class offer. You're going to tell your real estate agent to write an offer for more than the asking price. You'll offer $515,000 for the house with one condition. You're asking for a $15,000 seller concession to be credited back to you at closing to cover all of your closing costs. Now let's stop and look at what just happened from the seller's perspective. What do they see? They see an offer for $515,000. That's $15,000 over their asking price. It immediately gets their attention. Then they see you're asking for a $15,000 credit. So they do the math. A sales price of $515,000 minus the $15,000 they give back to you means their net proceeds are $500,000. They are getting their full, original asking price. You've presented them with a full price offer, which in most markets is a fantastic win. But what about you? You're now paying $515,000 for the house, but you didn't have to bring a single dollar for closing costs to the table. That $15,000 that was a massive cash roadblock is now gone. Instead, it has been rolled into your loan. You've effectively financed your closing costs. Now you might be thinking, wait, doesn't that mean my monthly payment will be higher? And the answer is yes, but by an amount that is so small it's almost unbelievable. Let's do the math. An extra $15,000 on a 30-year mortgage at a 7% interest rate comes out to roughly an extra $100 per month. Think about that trade. Would you rather scramble to find an extra $15,000 in cash right now, on top of your down payment, moving expenses, and furnishing the new place? Or would you rather pay an extra $100 a month? For 99% of homebuyers, that is an incredible deal-saving trade-off. You're solving a massive, immediate cash flow problem with a tiny, manageable, long-term adjustment to your budget. This is how you buy a house without draining every last penny from your bank account. Okay, this sounds incredible, and it is. But there are 3 critical rules you absolutely must follow for this to work. Ignoring them can cause your entire deal to collapse. Rule number 1, and this is the most important: the house must appraise. The bank is only going to lend you money based on the home's official appraised value. In our example, you offered $515,000. A licensed appraiser will go to the property and determine its fair market value. If that appraiser comes back and says the house is worth $515,000 or more, you are golden. The bank is happy, the seller is happy, you're happy. But if the appraiser says the house is only worth $500,000, you have a problem. This is called an appraisal gap. The bank will only lend based on the $500,000 value, and that $15,000 difference has to be made up somehow, which usually means the deal has to be renegotiated or it falls apart. This is why this strategy works best on homes that are priced fairly or even slightly under market value, giving you that wiggle room for the appraisal. Rule number 2. You cannot ask for an unlimited amount of money. Every type of mortgage has strict limits on how much a seller is allowed to contribute. Your lender will know these inside and out, but you should too. For conventional loans, the most common type, the limit depends on your down payment. If you put down less than 10%, the seller can only contribute up to 3% of the sales price. If you put down between 10% and 25%, the limit jumps to 6%. Put down more than 25% and it's 9%. For government-backed loans, it's a bit different. FHA loans allow up to 6% in seller concessions. VA loans for our veterans allow up to 4%, and USDA loans for rural areas allow up to 6%. You absolutely have to work with your agent and lender to make sure the credit you're asking for falls within these legal limits. And rule number 3, you need a great real estate agent. You can't just scribble this on a napkin. A skilled agent knows how to write this into the purchase contract legally and professionally. They also know how to present it to the seller's agent in a way that highlights the benefit to the seller, that they're getting their target price, which makes them far more likely to accept. Now, this seller concession strategy is, in my opinion, the absolute best way to handle closing costs. But it's not the only way. There is another option called a lender credit. This is where the bank, your mortgage lender, offers to pay some or all of your closing costs for you. It sounds great, but there's a major catch. In exchange for this credit, the lender will give you a higher interest rate on your loan. This isn't for a year or two, it's for the entire life of the loan for all 30 years. So let's compare. With the seller concession strategy, you increased your loan balance by $15,000, but your interest rate stayed the same. With a lender credit, your loan balance stays at $500,000, but your interest rate might go from 7% to, say, 7.5%. Over 30 years, that higher interest rate will cost you tens of thousands of dollars more in interest payments. The seller concession strategy is almost always the cheaper option in the long run. The only time a lender credit might make sense is if you know for a fact you're going to be selling the house or refinancing in just a few years. So to recap this massive topic, closing costs are a huge cash hurdle, but they are not unbeatable. Your primary weapon is the seller concession, where you strategically increase the offer price to have the seller credit your closing costs back to you. This moves the expense from a lump sum of cash you need now into your mortgage, resulting in a tiny increase in your monthly payment. Just remember the 3 golden rules. The house must appraise, you must stay within the legal concession limits for your loan type, and you must use a great agent to write the offer. By understanding this one powerful concept, you put yourself light years ahead of the average homebuyer, giving you the financial flexibility to not just buy a house, but to do so without making yourself broke in the process. To write the offer. By understanding this one powerful concept, you put yourself light years ahead of the average homebuyer, giving you the financial flexibility to not just buy a house, but to do so without making yourself broke in the process. And that brings us directly to the 8th biggest question. A silent budget killer that drains thousands of dollars from unsuspecting buyers every single year. It's a phantom payment, an extra fee tacked onto your mortgage that feels like a penalty for not being wealthy enough to begin with. The question is, what is PMI and how in the world do I get rid of it? PMI stands for Private Mortgage Insurance. And right away, that name is misleading. Because while you are the one paying for it, this insurance doesn't protect you at all. Not one bit. It protects your lender. It's an insurance policy you are forced to buy for the bank, in case you default on your loan. Think about how wild that is. It's like being forced to pay for your landlord's car insurance. It does nothing for you, except drain your bank account every single month. So why does this exist? To understand PMI, you have to think like a bank for a second. Imagine you're the lender. Someone comes to you and asks to borrow $300,000 to buy a house. That's a massive risk. Your only real security is the house itself. If they stop paying, you can foreclose and take the property back. But what if the housing market dips? What if by the time you take the house back, it's only worth $250,000? You just lost 50 grand. That's the bank's ultimate nightmare. To protect against this nightmare, they came up with a magic number. 20%. 20% down payment. If you can put down 20% of the home's value in cash, the bank sees you as a safe bet. They believe that even if the market dips, your 20% equity acts as a giant cushion, protecting their investment. They figure you're also far less likely to walk away from a home you have that much skin in the game for. With 20% down, you are in the clear. But what if you can't? What if you only have 5% or 10% down? In today's market, saving up 20% of a home's price is a monumental task. The banks know this. They still want to lend you the money, that's how they make their money after all, but they see you as a higher risk. Their nightmare scenario of losing money is back on the table. And that is the birthplace of PMI. The bank says, okay, we'll give you the loan with only 5% down, but on one condition. You have to buy this insurance policy, this PMI. And every month you'll pay a premium for it. If you ever default and we lose money selling the house, this insurance policy will pay us back for our losses. So, you pay $100, $200, maybe even $300 extra every single month, directly to an insurance company, for the privilege of protecting the bank that's already charging you interest. This isn't a one-time fee. It's a recurring charge that can add up to thousands of dollars per year, and tens of thousands over the life of the loan, for a product that gives you zero personal benefit. It simply allows you to get into the house. Now that you know what it is and why it feels like such a scam, let's get to the important part. How to defeat it. There are 4 primary ways to avoid or eliminate PMI. The first strategy is the most obvious. Put 20% down. I know, if it were that easy you wouldn't be worried about PMI. But it has to be said. If you can scrape together that 20% through savings, gifts from family, or by looking at slightly less expensive homes, you will sidestep the PMI issue entirely from day one. It's the cleanest path, but for many, it's just not realistic. So let's move on to the more creative strategies. Strategy number 2 is an old-school trick called a piggyback loan. You may hear it called an October 10th 80 loan. This sounds complicated, but the concept is brilliant. Instead of getting one giant loan for 90% of the home's value, you get 2 separate loans. The first, primary mortgage, is for exactly 80% of the home's value. Remember that magic number? Since this loan is at 80%, it does not require PMI. Then you put 10% down in cash. For the last 10%, you take out a second, smaller loan, often a home equity line of credit or HELOC. This piggybacks on top of your main mortgage. The result? You get into the house with only 10% down, but you completely avoid paying PMI. The downside is that you now have 2 separate mortgage payments to make each month, and that second loan might have a variable interest rate. But for many people, the math works out, and paying a second loan is still cheaper than paying for useless PMI. Strategy number 3 is a bit of a deal with the devil. It's called lender-paid mortgage insurance, or LPMI. The name sounds great, right? The lender pays it. But you know there's no such thing as a free lunch in the world of finance. With LPMI, the lender covers the cost of the mortgage insurance, but in exchange, they charge you a slightly higher interest rate for the entire life of the loan. For example, instead of a 6.5% interest rate plus PMI, they might offer you a 6.75% interest rate with no PMI. In the short term, your monthly payment might be lower. But because that higher interest rate is permanent, you could end up paying far more over 30 years. This strategy can make sense if, and only if, you are absolutely certain you will sell the house or refinance in just a few years. Otherwise, you're trading a temporary problem, PMI, for a permanent one, a higher interest rate. And that brings us to the fourth and, for many people, the most important strategy, getting rid of PMI after you already have it. If you couldn't use one of the first 3 strategies and you're now stuck paying PMI every month, do not despair. You are not stuck with it for 30 years. You have a battle plan. By law, your lender is required to automatically terminate your PMI once your loan balance is scheduled to reach 78% of the original purchase price of your home. This is the passive approach. If you do nothing and just keep making your regular payments, it will eventually go away. But you don't want to be passive. You want to be proactive. The law also states that you can formally request to have your PMI canceled once your loan balance reaches 80% of the original purchase price. You have to write a letter, be in good standing, and you might have to prove the property value hasn't declined. But by simply being proactive, you can shave months or even years off your PMI payments. But here is the real secret weapon, the game changer that most homeowners don't know about or don't use. Your equity doesn't just grow from paying down your loan. It grows when your home's value appreciates. Let's say you bought your house for $400,000 with 10% down, which is $40,000. Your loan is for $360,000. You need 20% equity to get rid of PMI, which on a $400,000 home is $80,000. You're $40,000 short. Now let's say 2 or 3 years go by. The housing market in your area has been hot. You've been watching Zillow and you see homes like yours are now selling for $500,000. Your loan balance might have only been paid down to $350,000, but your home is now worth $500,000. Your equity is not the purchase price minus your loan. It's the current market value minus your loan. So, $500,000 minus $350,000 is $150,000 in equity. That is 30% of your home's new value. You are well past the 20% threshold. At this point, you can call your lender and request to have PMI removed based on the home's current appreciated value. They will most likely require you to pay for a new formal appraisal, which might cost $500 or $600. But that is a tiny price to pay to potentially eliminate a $200 a month payment for the next decade. This single move, leveraging your home's appreciation, can save you tens of thousands of dollars. It transforms your home from just a place to live into an active tool for improving your financial health. So PMI is not a life sentence. It's a temporary hurdle. Whether you avoid it from the start with a 20% down payment or a piggyback loan, or you strategically eliminate it later by tracking your home's value, you are in control. Understanding this one fee separates the amateur homebuyer from the savvy homeowner who knows how to make their money work for them. And speaking of making your money work for you, let's tackle the one cost that blindsides more buyers than any other. It's the final boss battle before you get the keys to your kingdom. We're talking about question number 9. What are closing costs and how much should I actually budget for them? Everyone focuses on the down payment. It's the big, shiny number everyone talks about. But the down payment has a silent, sneaky, and often more confusing twin: closing costs. This is the collection of fees you have to pay to finalize the mortgage and transfer ownership of the property from the seller to you. Think of it like this. The purchase price of the house is the ticket price for a flight. The closing costs are all those extra taxes, baggage fees, and service charges that show up on the final screen and make you say, "Wait, where did that come from?" Ignoring them is one of the biggest mistakes a homebuyer can make, because they are not small. We're talking about thousands or even tens of thousands of dollars you need to bring to the table in addition to your down payment. So let's pull back the curtain and demystify this beast once and for all. Closing costs can be broken down into 3 main categories. First, you have the lender fees. These are the costs your mortgage provider charges for the service of creating your loan. The biggest one is often the origination fee. This is essentially the lender's commission for doing the deal. It's usually calculated as a percentage of the loan amount, maybe around 0.5% to 1%. Then you might see an underwriting fee, which pays for the salary of the person who meticulously verifies your financial life to make sure you're a good risk. A processing fee for the paperwork wranglers. A credit report fee. And an appraisal fee. Now, the appraisal fee is a tricky one. You pay for it, but it's not for you. It's for the lender. They hire an independent appraiser to confirm the house is worth the price you're paying. So if you default on the loan, they can sell the house and get their money back. It's a fee you pay to protect the bank. The second category is third-party fees. These are charges from all the other companies involved in the transaction that are not your lender. The heavyweight champion in this category is title insurance. This is non-negotiable, and it's incredibly important. A title company does a deep dive investigation into the property's history to make sure the seller actually has the legal right to sell it to you. They check for old liens from unpaid contractors, surprise heirs who might claim ownership, or property line disputes. You'll likely pay for 2 policies. A lender's title insurance policy, which is mandatory and protects the lender, and an owner's title insurance policy, which protects you. My advice? Get the owner's policy. It's a one-time fee paid at closing that protects you for as long as you own the home. It's the peace of mind that prevents a legal nightmare down the road. Other third-party fees include the settlement or escrow fee, which goes to the title or escrow company for conducting the closing, and potentially a survey fee if one is needed to verify property lines. The third and most confusing category is prepaids and escrows. Now listen closely, because this is where people get lost. These are not technically fees. This is your money that you're prepaying for expenses you'll have as a homeowner. The 3 big ones are property taxes, homeowner's insurance, and prepaid interest. Your lender will require you to pay for your first full year of homeowner's insurance upfront at closing. They will also collect a few months' worth of property taxes to put into a special savings account called an escrow account. From now on, a little piece of your monthly mortgage payment will go into this escrow account, and the lender will use that money to pay your property tax bills and insurance premiums on your behalf when they're due. Why? Because the lender has a massive financial stake in your home. They want to make absolutely sure the property is insured against disaster, and that the government doesn't seize it for unpaid taxes. The final piece is prepaid interest. Your first mortgage payment isn't usually due until the first day of the month after you close. So if you close on May 15th, your first payment isn't until July 1st. The lender needs you to pay the interest for the remaining days of the month you closed in. So at closing, you'd pay the interest from May 15th through May 31st. It's a small detail, but it's another line item on that final statement. Okay, that was a lot. Lender fees, third-party fees, prepaids. So what's the grand total? How much cash do you actually need? The standard rule of thumb is that closing costs will be between 2% and 5% of the home's purchase price. Let's make that real. On a $400,000 home, you should be prepared to pay anywhere from $8,000 to $20,000. Yes, $20,000. On top of your down payment. Seeing that number is exactly why so many deals fall apart at the last minute. Buyers scrape together every penny for the down payment, only to be sucker punched by the closing costs. But you won't be one of them because you're going to be prepared. So how do you manage this? First, you need to know that you are not flying blind. Within 3 days of applying for a mortgage, your lender is legally required to give you a standardized, 3-page document called a loan estimate. This is your holy grail. It will list every single estimated closing cost. Some of these costs are fixed like the appraisal, but there's a magical box on page 2 called Services You Can Shop For. This is your opportunity to save money. This includes things like the title insurance and settlement services. Your lender will give you a list of their preferred providers, but you have the right to shop around and find a cheaper option. A few phone calls can literally save you hundreds, if not thousands of dollars. Second, you can negotiate. You can ask the seller to pay for some or all of your closing costs. This is called a seller concession. In a buyer's market, where sellers are motivated, it's a very common request. You might offer a slightly higher purchase price in exchange for the seller giving you a credit at closing. For example, you could offer $405,000 for that $400,000 house and ask for a $5,000 seller credit. This basically lets you finance your closing costs into the loan, reducing the amount of cash you need to bring to the table. It's a powerful strategy, but it depends entirely on your local market conditions and the seller's willingness to play ball. Finally, you might hear about no closing cost mortgages. Be very, very careful. Nothing in life is free, and that is especially true in the world of finance. A no closing cost mortgage isn't a gift. The lender is simply rolling those costs into your loan in a different way, by charging you a higher interest rate. You pay less upfront, but you'll pay significantly more in interest over the 15 or 30 years you have the loan. It might make sense in a very specific situation, say if you know you're only going to be in the home for a couple of years, but for most people it's a bad deal. Understanding closing costs is about transforming a moment of panic into a moment of power. By knowing what the fees are, reviewing your loan estimate with a fine-tooth comb, shopping for services, and understanding your negotiation tactics, you turn one of the most intimidating parts of buying a home into a manageable checklist. You walk into that final meeting not with anxiety, but with the confidence of someone who knows exactly where their money is going. You've made it. You've navigated the pre-approval, found the house, locked your rate, and budgeted for every last cent of your closing costs. You're sitting at the closing table, looking at a stack of paper a foot high with a pen in your hand. But what exactly are you signing? What happens in that final nerve-wracking hour that officially makes you a homeowner? That brings us to our final and most important question. What happens at closing? This is it. The final boss battle of home buying. You've conquered pre-approvals, navigated house hunting, won the offer war, survived the inspection, and endured the underwriting marathon. Now you're sitting at a table in a sterile conference room with a notary or an attorney you've just met, and a stack of documents that looks like a novel written in a language you don't understand. This single moment is all that stands between you and the keys to your new life. So let's pull back the curtain on this mysterious ceremony and demystify every single step. First, let's talk about that stack of paper. It's intimidating, but it's not a random collection of legal mumbo-jumbo. It's the story of your home purchase, written down in binding contracts. And while there are dozens of pages, you really only need to understand the big four, the four horsemen of your closing documents. The first and most important document you'll see isn't even a surprise. Or at least it shouldn't be. It's called the Closing Disclosure, or the CD. By federal law, your lender must give you this document at least 3 business days before your closing date. This is your consumer protection superpower. This 3-day window is your time to review every single number, without the pressure of a notary staring at you. The closing disclosure is the final, itemized bill for your home purchase. It's the truth serum for your loan. You need to take this document and compare it line by line with the loan estimate you received when you first applied. They should be nearly identical. If the numbers are wildly different, if the interest rate is higher, if there are new junk fees you don't recognize, you need to call your loan officer immediately. That 3-day period is your legal right to hit the brakes and ask, "What is this?" The CD breaks everything down into obsessively detailed tables. You'll see the final loan amount, your interest rate, your exact monthly payment including principal, interest, taxes, and insurance, your PITI. Then you'll see a section called Closing Cost Details. This lists every single fee from the appraisal fee to the title insurance to the attorney fees to the recording fees paid to the county. It shows who paid what, you, the seller, or the lender. But the most important number on that entire document, the one you should find with a highlighter, is at the bottom of page 1. Cash to close. This is it. This is the final exact dollar amount you need to bring to the table. No more estimates. No more guesswork. This is the number you'll be wiring or writing on a cashier's check. If this closing disclosure is the final bill, then the next document is the promise you make to pay it. This is the promissory note. Think of this as the ultimate IOU. It's a surprisingly simple document, usually just 2 or 3 pages long, but it's arguably the most powerful. This piece of paper is your personal, legally binding promise to repay the loan. It has nothing to do with the house itself. If you were to sign just this document and nothing else, you would still owe the bank hundreds of thousands of dollars, even without getting a house. The promissory note spells out the core terms of your deal with the lender. You'll see the total amount you're borrowing. You'll see the interest rate clearly stated. You'll see the date your first payment is due, and how many payments you'll make over the next 30 years. It details what happens if you pay late, the late fees, and what happens if you fail to pay at all. This is the document the bank holds onto. It's the evidence of your debt. When you sign this, you are officially, personally on the hook for the money. So if the promissory note is your promise to pay, how does the house get involved? That's where our third horseman comes in. The mortgage, or in many states, the deed of trust. This is the or else document. This is what connects your IOU from the promissory note directly to your new property. It's the security instrument. It gives the lender a legal interest in your home until the loan is paid off. In simple terms, this document says, I promise to pay back the loan as outlined in the promissory note. And if I don't, the lender has the legal right to take this specific property, sell it, and get their money back. That process is called foreclosure. This is the document that gets publicly recorded with the county. It puts the entire world on notice that while you are the owner of the home, there is a lender with a primary claim, a lien against it. It's the bank's insurance policy written on your house. Signing this is a heavy moment, but it's the fundamental pillar of how mortgage lending works. It's the collateral that makes these massive loans possible in the first place. So you've reviewed the final bill, you've signed the IOU, and you've pledged the house as collateral. Now for the grand prize, the fourth and final key document, the deed. This isn't a loan document at all. This is the ownership document. This is what you've been working for. The deed is the legal instrument that officially transfers the property from the seller to you. The seller has actually already signed this before you ever get to the table. The closing agent is just holding it in escrow. The deed will have the legal description of the property, not just the street address, but the specific lot and block number on a surveyor's map. More importantly, it will state exactly how you are taking ownership or taking title. Are you a sole owner? Are you joint tenants with right of survivorship with your spouse? Meaning if one of you passes away, the other automatically inherits the whole property? This was decided earlier in the process, but this document makes it official. Once the closing is complete and the money has all been transferred, the closing agent takes this deed to the county recorder's office. Once it's stamped and recorded, you are the undisputed official public owner of that property. So you'll sign the CD, the note, the mortgage, and 100 other smaller disclosures and affidavits. Your hand will cramp. You'll feel like you're signing your life away. But here's the secret. You are allowed to ask questions. The closing agent is not just a signature witness. Their job is to give a brief explanation of each document you're signing. If you don't understand something, stop and ask. Can you explain this page to me in simple terms? Don't be intimidated into just signing. This is your moment. After the last signature, you'll hand over your cashier's check or show the confirmation of your wire transfer for that cash to close amount. The closing agent will do a final check to make sure the lender's money has arrived and all the funds are accounted for. And then it happens. The closing agent will slide a small set of keys across the table. They're cold and metallic and probably on a cheap ring from the seller's agent. But when you pick them up, they are the heaviest thing you have ever held. In that instant, everything changes. You are no longer a homebuyer. You are a homeowner. The entire journey, the searching, the stress, the endless paperwork, it all condenses into that one single tangible moment. The feeling is indescribable. It's relief, it's terror, it's pride, it's exhaustion. But what happens next after you walk out of that office, keys in hand? Few things. The loan gets funded, meaning the lender sends their money to the seller. The deed and mortgage are officially recorded at the county office. And then, about 2 or 3 weeks later, you'll get your first piece of mail as a homeowner. It will likely be a letter from your new mortgage servicer. And don't be surprised if, a month or 2 later, you get a letter saying your loan has been sold. This panics almost every new homeowner, but it is completely normal. Lenders sell loans all the time. The only thing that changes for you is who you send the check to. The terms of your loan, your interest rate, your monthly payment, the amount you owe, are locked in by that promissory note you signed. They can never change no matter who owns the loan. And that's it. That's the entire journey. From that first, timid question of how much can I afford, all the way to holding the keys to your own front door. It's a marathon of finance and emotion, but by understanding each step, you transform a process that feels overwhelming into a series of manageable, conquerable goals. You've armed yourself with knowledge, and that is the single greatest asset you can have in this process. So congratulations. You've earned it. Now go open your new front door.